Looking to add Canadian growth stocks to your portfolio but don't know which ones to pick? Want to add a few riskier stocks to your portfolio that could reap massive rewards in the future? This video will be briefly breaking down 2 Canadian tech/growth stocks to add to your portfolio. I practice what I preach, so I own stock in both of these companies. I wouldn't recommend companies that I'm not personally invested in or don't plan to invest in. Wait, can I take that back? Eventually, I'll run out of stocks to recommend that I already own, and I'll also run out of money to invest into new stocks. Please note, before I get started, these are speculative purchases. The expectation is they will be big. They have a good product, they have good service, and in 3, 4, maybe 5 years, they'll start earning a profit and the return on your stock will be massive. If you're looking at growth stocks and their projections are 8, 10, maybe 15 years away, like, oh, in 2033, this will be big, I personally would shy away from those. Everyone should be thinking of the future, they should be thinking long term, but a company not being able to make profit or cash within 8, 9, maybe 10 years might be too risky because eventually they'll run out of cash. That well will run dry. Speaking of a well running dry, my first stock that I'd like to break down and recommend is Well Health Technologies. Ticker well.to because it's on the TSX. The current stock price is $6.64, but this will have significantly changed by the time this video comes out. There are no dividends, this is a growth stock. They need the cash for acquisitions and reinvesting in the company. Your returns will come purely in the form of stock appreciation. Just take a look at this 100% increase in just a few months. Current market cap of $870 million sounds like a lot, but still a baby in the tech industry. Taking a look at this snippet directly from their MD&A, Well aims to empower and support patients and doctors. They own and operate 20 healthcare clinics in BC, but this isn't their main moneymaker, it's their software. They service over 10,000 medical professionals through their medical records software. Their goal is to modernize primary healthcare using their software to improve patient experience, operational efficiency, and overall care performance. Anyone who has used Canada's prehistoric healthcare system knows it's in dire need of a massive overhaul. That's where Well comes in. But not only in Canada, they've recently announced that they're expanding into the US as well. Canada's care delivery sector is estimated to be worth $242 billion alone. The management team believes that there's significant market share available for a company that can come in and digitize the primary healthcare sector. That's exactly what Well is trying to do. According to a Canadian survey, only 15% of Canadians were able to access their health records electronically. Only 8% were able to make appointments online, and even less, around 3%, were able to have video consultations online. In that same study, over 75% of respondents said they would like all those options available. They would like to see their health records online. They would like to be able to make appointments online, and they would like the option of a video consultation. This is what Well is trying to do. They're filling a need. There is a demand. They're filling a gap, and that's what we're investing in. Taking a look at their financial performance, again, it's a growing company, not an established industry leader yet, so their financial statements look rough. These aren't great numbers yet, but we're looking for trends. Take a look at the past 5 quarters. Increasing revenues, that's awesome, especially their digital services. Increasing net loss, that's not good, but it is to be expected with the company at this stage of its life cycle. Increasing cash, which is great for growth. Lastly, take a look at their EMR network clinics. Huge increases, which is exactly what investors want to see. Looking at their balance sheet, very basic analysis here. Assets greater than liabilities, great. Current assets much greater than current liabilities, great. Even deeper, take a look at cash. Cash itself is greater than current liabilities. But here's where growth stocks are different. I know they're going to be spending this cash. They're following a very aggressive growth strategy, which means acquiring other companies. So this $24 million is here for now, but it will be gone. Just a few weeks after these statements came out, Well bought a US company for $14 million US dollars, which is over 18 million Canadian dollars, and there goes all your cash. Another reason these statements might appear better initially, assets are 89 million, liabilities are only 36 million. Well's debt is low because they keep issuing stock to get more cash. They're diluting shareholders' current holdings by issuing millions of shares to raise cash. So the liabilities look low, but there are no free rides. The cash came from somewhere. One last item, take a look at this. Intangible assets, 38 million. This number's massive. It's the largest asset they have. But what is it? It's mainly goodwill. Due to their aggressive acquisition strategy, they're overpaying for companies they've purchased. That's where this goodwill and this number comes from. You can't sell this. If you need to cover debt, you look at your assets and think, oh, we have 89 million. We can liquidate and cover our debt, but goodwill doesn't work that way. Let me give a very basic example of what this means. Let's say I purchase 10 properties for 1 million each. I'm turning around and selling them, but does this mean I'm selling them for 10 million? No, not a chance. I'm charging 11 million. That extra 1 million is a portfolio premium. I did all the legwork. I did all the due diligence. I bought all the properties. I'm putting them together as a package. When I'm selling it to someone, they're going to pay an extra 1 million. They're paying that premium. That portfolio premium, that's considered goodwill in this case. Lastly, let's take a look at their cash flow statement. I usually recommend looking at a company's cash from operating activities. But remember, this is not a well-established and fully functional company yet. Their normal operations are running a deficit. They have a cash loss, which is fine, this is to be expected. The other metrics on the cash flow statement are more important. Cash flow from investing activities. You want to see the company constantly using the cash to grow. And cash from financing activities. You want to see the company continuously able to raise capital to further invest and grow the business. I've recently doubled up my holdings to 200 shares of this company. I bought in around the mid $5 range. I'm hoping in the future there'll be options available for this company so I can sell covered calls, further increasing my income and my gains from holding this stock. I do think this is a great speculative purchase for anyone looking, for a slightly risky stock. I know there's no guarantee it will be the next Tesla, the next Shopify, but you need to take some risk. You need to find some companies at their infancy, and I do think this is a great company if you're looking for another great speculative purchases with great upside potential. The second stock I'll be breaking down is Durham, ticker symbol DND.TO because it's on the TSX. DND is another tech company that provides a cloud-based software to potential clients. More specifically, they operate in the legal technology industry. The platform automates certain processes such as due diligence searching, document creation, and e-filing. It is currently aimed at legal, finance, and business professionals looking to optimize workflow and increase productivity. They even have their biggest client is Bank of Nova Scotia. Let's take a look at the ticker. Again, the stock moves so much, this will be updated by the time you see it, but the current stock price is $25 per share. If you're looking at the dates, notice the 6-month chart only goes to July 2020. That's because the company just went public. They're not a brand new company, but they're a brand new public company. They recently did an IPO and will use those funds to grow and invest in the company. If we look briefly at their prospectus, I won't go into pro forma numbers, let's look into full year results. Revenues are growing rapidly. Awesome. Even better, take a look at this gross profit ratio. Almost 95%. The CEO mentioned they're a high revenue, high gross margin company, but this margin seems almost too good to be true. One rare item for a newly IPO tech stock is a positive cash from operating activities number. I wasn't expecting this at all when first looking into the company. This is obviously due to the low cost of revenues, but I don't expect or demand for it to stay positive as the company continues to grow. Look at the stats provided by this infographic. 71% revenue cumulative annual growth rate and 136% cumulative annual growth rate of the EBITDA, earnings before interest, tax, depreciation, and amortization. They've been following an aggressive acquisition strategy, like they should, like all tech growth stocks should. They've acquired 14 businesses since 2013. They're not just buying out their competition, they're trying to expand their current product suite and use the acquisitions to enter new markets. I know I'm recommending this company, although they're a brand new IPO and we have yet to see what they will do. I did mention these are speculative purchases. This is a riskier purchase if you were to include it in your portfolio. I've purchased a small portion of their stock, hopefully hold for the long term and, maybe see massive rewards in the future. That's all for this video. I hope it's not too long. It took forever to film actually. Please let me know if there are any other stocks you'd like broken down and recommended. I'm currently looking into breaking down 2 other stocks, CloudMD and Docebo, I believe. So look out for those in the future. They were recommended by a subscriber. So thanks guys.